Last year, Australian residential property has shown a 23.7% growth in just 1 year, which is way above the average annual growth of 6.8%. As both the US federal and Australian RBA lifted the cash interest rate, housing prices are bound to fall sooner or later as the borrowing costs increase. So I want to make this video in case you want to enter the property market sometime in the near future. Generally, there are two ways to invest in real estate: the traditional direct real estate investing and REITs. In this episode, I'll be talking about how does REIT work, the pros and cons of investing in REITs, and when you should own REITs because REITs might not suit everybody, and what are the REITs products that are available if you want to invest in Australian A REITs or global REITs. My name's Irene. Now let's jump right in. REITs has been around since 1960s, and it stands for Real Estate Investment Trust, which are companies own and operate real estate or its related assets. And REITs act like mutual funds for real estate investing, and this makes it possible for individual investors to earn steady dividends from rent without having to buy, manage, or finance any properties themselves. The Australian Real Estate Investment Trust is also called A REITs, and some A REITs are stapled securities, which means a share in an A REIT consists of one unit in the property trust and one share in the company stapled together, so they cannot be traded separately. And the trust holds the portfolio of assets, and the company carries the fund's management functions. There are quite a few criteria to be qualified to be a REIT, and there are two major requirements a REIT needs to meet that make it stand out from other asset classes. Number one, a company must have at least 75% of its assets in real estate and cash. A REIT must distribute at least 90% of its taxable income to shareholders annually in the form of dividends. Also, REITs enjoy a special tax treatment, which they are allowed to deduct all of the dividends that it pays out to its shareholders from its corporate taxable income. Therefore, most REITs pay out at least 100% of their taxable income to their shareholders, and then they don't have to pay any corporate tax. This is why you normally see REITs payout ratio is around 100% or more. What makes REITs different from other real estate companies is that a REIT must acquire and develop its real estate properties primarily to operate them as part of its own investment portfolio, not to reselling those properties after they have been developed. And most REITs specialize in a single type of commercial real estate. They can be office buildings, shopping malls, apartments, healthcare, resorts, data centers, and mortgage or loans. In a broader sense, REITs typically fall into three categories: equity REITs, mortgage REITs, and hybrid. And equity REITs are the most popular ones, and they lease space and collect rents, so their revenues is primarily through rents. And mortgage REITs don't own real estate. They lend money to real estate owners either directly through mortgages and loans or indirectly through mortgage-backed securities. And their revenues are primarily made up of net interest margin, the difference between the interest that they earn on mortgage loans and the cost of funding this loan. And due to this operating model, mortgage rates are more volatile than equity rates as they are more sensitive to interest rate changes. And REITs have their advantages and disadvantages, so let's talk about the pros and cons of investing in REITs versus direct real estate investing. And one of the advantages that REITs have is illiquidity. REITs are easy to buy and sell just like shares, and you can gradually build property investments or withdrawals for almost instant cash when you sell. And this is probably the biggest drawback of direct property investing. You have to buy or sell an entire property, and it takes time both ways. Investing in REITs could give you instant access to commercial property with small upfront investment. You can also build your property portfolio across different sectors, countries, and different types. And direct property investing requires down payment and is very bulky in a way, as you need to purchase it as a whole, and therefore you could find your portfolio easily concentrated towards real estate. And generally, most of the property investors invest in residential, while REITs can give you access to different types of commercial properties. REITs are highly regulated by local security and investment commissions. Like any public traded company, REITs are required to file financial reports audited by accounting firms, and all this information can be obtained very easily by investors. On the other hand, for direct property investing, it's a little tricky to work out the intrinsic value of the tangible real estate because every property is different, but this could be used as an advantage for investors to find undervalued properties. And REITs can provide a stable cash flow through dividends. REITs are designed to provide a sustainable income stream because by law, they must share 90% of their rent with the shareholders. For direct property investing, depending on the demand of the location, there might be vacant periods that you cannot find any tenants. And of course, REITs have its disadvantages. First of all, it lacks of control, that you don't get to pick which properties to buy and where, and the decision is left in the hands of the management team of REITs. REITs don't offer much in terms of capital appreciation. As part of their structure, they must pay 90% of the income back to investors, so only 10% of taxable income can be reinvested back into the venture. And this means that the price return is typically less than the normal stock. And also from the research that I did, the average REITs provides less total returns and the risk-adjusted returns compared to average large cap stocks, which I will show you in a short while. Dividends paid by REITs need to pay taxes, which can erode your long-term returns unless that you hold REITs in a tax-deferred retirement account in the US, such as IRAs and 401ks, or in Australia, your super funds needs to be in retirement phase when all investment earnings, including capital gains within the account, will be completely tax-free. And of course, direct property investing has its advantages as well. When you purchase a property, you get to pick the location and the type of property, and you'll be the owner, and then you have full control of it. And it's very tangible. You can visit it, you can touch it, and you can fix and flip for short-term profits, but you have to deal with the potential maintenance costs and management hassles. Many investors, they use leverage through the direct property investing. Any expenses to manage the property is tax deductible too. Direct property investing can offer capital appreciation as well. Now, let's look at REITs' historical performance compared to large cap equities both in the US and Australia. If we compare the total return of S&P 500 with S&P US equity all rate indices, REITs are more volatile with lower risk-adjusted returns. And let's look at Australia. If we compare the total return of ASX 200 with ASX 200 A-rate indices, REITs are definitely more volatile with lower risk-adjusted returns. Although REITs can provide you with a unique exposure to commercial real estate, from what we just saw, the total returns as well as its risk-adjusted returns are still not as good as stocks. Like any income-generating securities, REIT is not for everybody. If you're an investor who has fairly a long horizon to go, having much REITs in your portfolio may drag your long-term total return, especially the additional tax that you need to pay. However, their income returns could be doubled of stocks, which makes it perfect candidate for retirees who need the stable income streams, especially REITs sit in their tax-deferred retirement account. Of course, we are comparing the general REIT market. There are individual REITs that outperform the average return of general REIT market. You can invest in publicly traded individual REITs, both A-REITs and global REITs, as well as REIT ETFs through an online broker just like shares. And some fund providers offer REITs in managed fund forms, such as Vanguard Personal Investor. And many superannuation funds have REITs in their investment options to gain steady income as well as for diversification purpose. REITs are favored by income investors. If you're looking for income, you may want to check my income investing series where I talk about the pros and cons of income investing and different income generating securities. I hope you grab some information out of this video. My name's Irene. I'll see you next time. Bye.